This is an example of a bullish iron condor and a bullish butterfly spread trade. Just to compare the two, butterflies and simple condors, very similar. The iron condor varies from those. If you look at butterflies, they tend to have all calls or all puts in their use. When you look at an iron condor, you'll find a mix of puts and calls. It's a put spread and a call spread trade combined. They look very similar in their outcomes, but the initial setup of the trade has one strong benefit for the iron condor, and that is that usually you end up with money in your account as you initiate the trade and smaller margin requirements, whereas the butterfly requires cash paid out to set it up. So let's take a look at this. This is Tesla trading about 335. And so if we think that Tesla's going to move up a little bit and we want to do it in a limited risk fashion, we could try a spread such as a butterfly spread or an iron condor to take advantage of, let's say, a move between, let's say, 335 and 350. The butterfly trade, looking at strike prices, as you go up in strike price, you would buy, then sell, then buy call options. The iron condor starts with puts, same pattern. It's buy, sell, buy, except it's buy a put, sell a call, buy a call. And so here are our strike prices, 335, 340, 345, 350. And so we're going to try and profit over that small range of movement. Here are the puts, same strikes, 35, 40, 45, 50. And we'll just follow that pattern. And we'll use 10 contracts to see, one, how much it costs to set each up, and two, what would be our payoffs and profits if we saw 335, 340, 345, 350. So let's take a look at the payoffs and profits. So setting them up, buying a call, $6.30, then you sell a call for $4, sell a call for $2.40, buy a call for $1.50. And you see the strike prices here as we go up. Prices for the actual calls change. So that's the butterfly setup. And you see that out of pocket, a net of $1.40 a share, 10 contracts, 1,000 shares, so $1,400. Doing the same trade, except now it's an iron condor instead of a butterfly. So it'll be buy a put, sell a call, buy a call. And again, going up in stock or strike prices means that you're betting on a stock move somewhat higher in this range in order to profit. So spending $480, receiving $740, the put pays for itself. Spending $150, receiving $240, the call pays for itself. And your net is $350 income to the account, 1,000 shares, so $3,500 income to the account. And here you'll see the payoff formulas for the iron condor. Going over here and looking at payoffs, let's say that stock prices are 335, 340, 345, 350 at expiration. Evaluate the butterfly, all those calls. Also, same stock prices, but evaluate the iron condor, the two puts and the two calls. And then find the profit by considering the either cost in the case of the butterfly or the income in the case of the iron condor for a final profit column. So here we go. The calls, you need prices above 335 for this call to have any value, and you're long the call. So at 340, it's worth 5, 345, it's worth 10, 350, it's worth 15. On the call you're short, any move above 340 is a loss, 5 and 10. And at 345, you only have one outcome that has value, and it'd be a loss because you shorted that call, 5. So 350, no value at any of these prices below or at 350. So evaluating at 335, no payoff values, just the 1400 you spent setting up the butterfly. At 340, you have a $5 times 1,000 shares, or $5,000 payoff, less the 1,400 that you paid setting it up, $3,600 gain. At 345, while the first call moves more positively, the second call is moving a dollar for dollar offset above 340. So the net is $5, just as before, $3,600 gain. And then at 350, you've got two negative call positions, offsetting the gains of the first, zero. So $1,400 cost is your loss on that position, and it would stay that way as you go out to 360 and beyond. Looking at the iron condor, the stock price at 335 has a value of 5 to the long put, where short put's at 340. So that's 5,000 loss. However, we had 3,500 income, so the loss is 1,500, almost the same as with the butterfly. The 340 stock price, nothing has value. 345, none of the puts have value. 345, the calls have zero value also. 350, the puts have no value. The 345 call has a value to the long call of 5. You're short the call there. So that's what? $5,000 loss. Considering the 3,500 income is a $1,500 net loss from that $5,000 payoff. Looking at the two, very similar payoff and profit ranges. The difference, iron condor, you start with 3,500 in the account. Butterfly spread, you end up spending money to set up the trade. So that's why iron condors are more popular today.